Hey everyone, how you doing today? Welcome to our expert series. We're here with Greg Dickerson. How you doing, sir?
Doing great, Michael. How are you?
I'm doing very well. So I think there's a conversation that needs to be had. I think there is too many investors out there that hear these two words and think they're the same. You and I know they are not. And that is leverage and margin. So when I talk leverage and margin in the same sentence, what do you think? Let's just riff on this a little bit because I think one is safe and one is remarkably dangerous.
Yeah, one is, give me all you got, and the other one is no thank you, Sam. No thank you, Sam. So,
Exactly.
uh, yeah, so we'll talk, leverage first,
Sure.
and there's good leverage and there's bad leverage. So in the world of real estate, there's good leverage, no alligators, according to your book.
Mhm.
You want to leverage your assets, leverage your properties, but you need to be able to service the debt, pay back any equity or private lenders so that you have positive cash flow. You don't even want to break even. You need
Mm-mm.
positive cash flow
Mhm.
so that you've got, the rainy day fund and reserves for any kind of repairs and things like that. You know, when you're borrowing on margin, so here's the difference. So when you have leverage, okay, you're leveraging your ability to borrow on an asset. Now, in commercial and investment income, it's based on the income of the property in terms of what they'll usually allow you to borrow and allow you to leverage and the value and things like that. So you have a steady, sustainable payment that you're making on that leverage. Now, you may or may not lose equity, you might gain equity. So some values can change there. The margins can change on that investment, but your payment's going to stay the same and your cash flow is going to keep coming in. When you're borrowing on margin for financial assets, now what you're doing is you're usually levering up a little higher than what you can on an investment property. And all of a sudden now you've taken on something that you don't have the money to pay for. So let's say you borrow, on margin $100,000 to buy stock and that stock goes to zero. Well, it's not like you just lost the equity. Now you got to pay that $100,000.
Mm.
When you're leveraging real estate and the value of real estate goes down from a million to 500,000, you don't have to come up with 500,000. It's just worth less, but
Mhm.
you still have income, you still have the property, and your payment is the same. When that margin call happens, you got to pay whatever that gap is between what you borrowed and what it is now worth.
Yeah. Again, in good times, again, consumers are very predictable, and they act. Most of them act in unison, right? Leverage and margin in good times kind of are treated the same, right? Some is good, more is better. That's the general feeling when times are good. But here's the deal, right? Like you said, leverage in real estate. And again, we'll just do single family homes and 30-year mortgages, right? You have a hiccup, you have 2 or 3 bad years like 08, 09, 10, as long as you're servicing the debt and can make the payments, the bank cannot call you and say, hey, Michael Zuber, your house is worth 50 grand less. Why don't you cut us a check for $25,000 to make up the delta? That doesn't happen. Stock
Well,
trading.
let's clarify. Let's
Sure.
clarify. They can do that. And they did do that in a lot of cases for investment properties and developers in 08, 09, but generally they don't. And especially right now, they won't as long as you're current, but they can. Once your house loses value, that's technical default. Once your property loses value, your income status changes, any of those types of things, that,
Mhm.
that's a violation of loan covenants,
Mhm.
so it will put you in technical default. But generally, they weren't doing that with single family, but they certainly were doing it to developers
Yeah.
and to investors that
Mhm.
had loans on the books that the values of those
Yeah,
assets
yeah,
changed.
we're definitely going to stay in residential. Talk about most
Yeah,
investors, right? The like our mom's single family homes that we talked about in episode 1. Our moms would never get a call if the values went under the loan. But yeah, if you're doing cross
no,
collateralization or doing commercial or ground up development, there's all kinds of load covenants. There's short term. I mean, it's a different ball game. So we'll stay in residential. But now you're a stock trader. You've been staying home for a year. You've been getting unemployment, or you've been working from home, and you there for a while there you couldn't bet on sports because sports was shut down. You start day trading in stocks. You get some beginner's luck, and all of a sudden you find out this thing's called margin. You can borrow tens, hundreds of thousands of dollars at 2%. You're like, damn, some is good, more is better. What if? What if? What if? And then you go 20, 30, 40, heaven forbid, 50% on margin. It feels great when the market goes up, but it only takes a very small haircut to A, get what's called a margin call or forced selling, or B, to lose it all with a, slightly exaggerated, and you could lose it in a day, right?
Yeah.
And I wanted to have this conversation because over the weekend in the crypto space, a lot of the stuff had a
Yeah.
20% haircut. I think it was late Saturday, early Sunday morning. And there was over 1 million people on margin that got washed out.
Yeah.
And that's that margin. They don't play. Margin can get you.
Well, during the Reddit thing, this one guy, that racked up about $1 million in a margin call, he killed himself,
Yeah, that was
and
really
he
sad.
was a
Yeah.
Robinhood. Yeah, he was a Robinhood trader. So I mean, it's a real thing, and that's the problem. Is a lot of people, Wall Street is a casino. Wall
Oh,
Street is Vegas. I
absolutely.
mean, they're on CNBC and Bloomberg talking about bets. What's your bet? How are you betting? What's your
How are
hedge?
you
This is
feeling? I love
gambling.
that. What
Yeah,
do you feel?
it's
Like, I'm a
gambling.
hot trader. What are you talking about? Feelings? What are feelings talking about? It's crazy.
Yeah, the game has changed. There's nothing technical. There's nothing fundamental. I don't care what you say. There's no ratios that make any kind of sense in the world of stocks, Bitcoin, cryptocurrencies, NFTs, any of that anymore. It's all
Yeah.
speculative. It's
Yeah.
all gambling, and it changes fast. And that's the thing that a lot of people don't realize. And, even when something like a GameStop happens, and your values are paired, you got to go twice as hard to get back. You got to earn twice as much to get back. When you go from 100 to 50, well, now you got to go double to get back to 100 because, of that basis, as it increases in, and that's the allure of it, the whole FOMO and YOLO and,
Yeah.
all these terms that are out there, which is great. If people don't care and they don't mind losing money, that's fine, but it's gambling is what it is. And that's the excitement of it. That's why
Oh,
it's
for
fun and
sure.
exciting to people.
Yeah. Yeah.
But there are real consequences. And I've been watching it, and this is not the time to get in,
No.
and the
Yeah.
whole Dogecoin, Doggy
Doge.
coin, whatever you want to call it,
Yeah.
Dogecoin, that whole phenomenon that's going on. I mean, it's just all
Come on,
speculation.
man.
And
It's the people's currency. Come on.
it's interesting to watch. And, so cryptocurrencies, I've studied them a lot, and I've learned a lot about them. And again, they're not currencies.
No, they're
They're
not a currency.
speculative assets, alternative assets. And, they are not a currency. And what's going to happen? All the governments around the world are all creating their own digital currencies. So those things are going to be alternative assets and speculative trading
Mhm.
bets, but they're
Mhm.
not going to be currency. They're not going to replace the
No,
dollar.
they're not going
Nothing
to
is
be.
going to replace the dollar.
Yeah, they're not going to be a currency, but they could be stores of value and all of that.
Yeah.
And I think they deserve. There'll be a percentage of allocation for some folks that makes perfect sense.
No, I think it's great. And here's the thought that I was having earlier today. Why don't we tokenize real estate instead of having
Oh,
deeds and titles and this and that?
amen.
Real estate is inefficient in terms of the
Oh, the
transactional
title and all
aspects
that.
of it.
Yeah,
All right. So let's tokenize real estate.
agreed.
Now you're going to have a, pushback from the governments, because how do you tax that? But
Yeah,
you just tax
true.
it on the transfers. But
Yeah.
that would be really cool if we could tokenize real estate. So if anybody's listening in the crypto space, give me a call. Let's tokenize real estate.
There you go. There you go. Yeah, I find a hard time investing, betting, gambling, speculating on a thing that was created as a joke.
Yeah.
I can't get behind that. Even though the joke's winning, but if you tell me the thing was created on a joke, I am not putting my money in that. I just can't get my head
Well, and
around
it's
that.
not just there. Did you hear about the New York deli that
Oh,
did,
10 million bucks or something? It was crazy.
no,
$100
$100
million.
million
$100 million.
valuation. Somebody, yeah, the guy took it public. It had $100 million valuation in stock issued. And here's a deli that doesn't even do, $80,000 a year in sales, some rundown deli.
Yeah.
Now the guy's in jail, that
Yeah.
did that now.
Total
He's been
fraud.
arrested, but
Yeah.
yeah.
Total fraud. Yeah. So again, folks, there's a big difference between leverage and real estate. Again, we're talking residential. It's you will not get called if the value falls. And then margin, I believe we're weeks or months away from and the other thing about margin that I just want to get on record here is when it goes south, it becomes a crowded trade because what did I tell you about consumers? They follow a herd. So what we've seen in the last 6 months, 9 months is a lot of people, new investors crowding into the same trade. When that trade breaks, whenever it breaks, there's going to be a rush for the exits and there's one door and you're probably not going to get through it. So be very, very careful.
Yeah, and the mentality is, and the viewpoint is, things are only going to continue to go up, and a lot of that's based on what the Fed does and the moves that they make and the liquidity that's been provided. But and right now they've been right because it's done
Yeah,
nothing but
yeah.
go up. But it's been unprecedented, liquidity pumped into the market to keep it going. So the question is, how long will it last? How sustainable is it? And can we really, and nobody knows, can we really stay on this path of quantitative easing and, policy from the Fed that we're on right now? Low interest rates, unlimited, liquidity. We have a liquidity issue. That's what's creating all this. There's tons and tons of money out there. So, are there actually any real consequences? And we're already starting to see inflation. You and I have talked about
Oh God,
inflation at the
yes.
consumer level and how we hadn't seen a lot of it. We're starting to see it now.
Well,
And it's everywhere.
yeah, it's everywhere. I mean, one of the things I'm watching this week, I talked about on my daily financial news show, is uh, companies talking about inflation. And first up, Monday morning, Coca-Cola talking about inflation in aluminum, plastic, and glass. Hello, folks.
Yeah.
If Coca-Cola is talking about it, and right now they're saying we can absorb it, but not forever. Think margin compression. But yeah, it's going to be interesting. So this has been a fun conversation, Greg. Any closing thoughts?
No, that's it. Be careful, understand the difference between leverage, margin, and just be careful. If you're out there playing, don't bet more than you can afford to lose.
Amen to that. Wise words. Thank you very much.